Alrighty. Well, hello everyone, and I'm sure a ton of you are really tuning in live, all five, maybe 10, 15 if we get lucky. But this week in review for real estate, I wanted to share with you a few things that popped up. Of course, it's going to be our rundown of our top five. So it's going to be hello everyone. Things like, I'm sure a ton of you are really tuning in. Things like the rental scams to avoid, good news for multifamily investors on smaller houses, and good news for multifamily investors in larger apartment complexes, as well as passive real estate benefits. And then some major mistakes to try and avoid when you are investing in commercial real estate. Then I'm going to hit you with the top three with a bonus post on some things that I found on social that I found rather interesting to share with you. And then, of course, close it out with the opinion piece on chess versus checkers and how that relates to your investment profile, whether that's in real estate, stocks, bonds, etc. So to get right into it, let's talk about rental scams. And why is that important? Well, hey, nobody likes somebody that commits fraud and nobody likes scams. It's a real pain in the ass. And the most recent data that I could find was in 2021. There was about $350 million lost to rental scams. The primary rental scams that you see out there are things like rental check fraud, cash rental payment fraud, ACH rental fraud, and credit chargebacks. You can read all about them. I'll make sure that it's in my link. In fact, it's actually in my weekly post on the real estate newsletter. But one of the biggest one is actually the rental check fraud. I think that's about 2/3 of the total fraud seen in rentals. And that ties to a few different things. One, let's say somebody is renting a unit for $3,000, but they write you a check for $3,500 by accident. And so they say, hey, I accidentally sent you $500 extra. Can you just write me a refund? You write the refund, but then when you go to actually cash that $3,500 check, you find out that it's a counterfeit check or it doesn't go through. Thus, you've actually paid $500 for somebody that didn't actually pay you anything. Then another kind of rental check fraud that occurs is when when somebody puts down their deposit and they say, hey, it's going to be, again, it's $3,000 for rent. They put down that deposit, but then they back out of the lease before they actually sign it. They ask you for a quick refund on it. You give that refund, but then again, the check isn't real. So the best way to really avoid this is, truthfully, have your property management team be very well vetted in the process to follow when it comes to vetting applicants on the first part. You can find out by just doing a thorough background research on if there's any judgments against these people in the past. And then two, just making sure they have a good training behind it. And three, use some technology. Don't take cash anymore. Don't take checks. Make people actually set up a payment plan in a system that makes it a lot harder to pull off fraudulent acts. So the next part that I want to touch on is some good news for multifamily owners. So for people that don't know it, I've been investing in large multifamily apartment complexes since like 2018. But then I dug in as a more active investor right here in Boston, which I bought a property during COVID, and then I built it into a multifamily, and it's only 3-unit multifamily. But this is where, it speaks to my heart, and thus I wanted to share it with more people, that Fannie Mae has announced starting in basically mid-November, you're no longer required to have 20 to 30% down to purchase a multifamily property, which is deemed anything between 2 and 4 units. Now you only need 5%. That's great for people because that's a new option and presents a great opportunity for people that are trying to create an additional stream of income, or at least offset their personal mortgage with somebody else's rental payments. So this really does open up the field for a lot more people to access this. And I highly encourage it, if you had the financial means, to try and look into it, or just reach out to me. I'm happy to walk you through at least what I did. And you can see if it's reapplicable for you. Now, other good news in multifamily. So there's 2 good news stories in multifamily right now. This one is now towards the multifamily passive investors in apartment complexes of 100 plus units, which is, what our team focuses on. And the positive news is there might actually be a light at the end of the tunnel. So, after record-setting 2021, then a very tough 2022 and a very tough 2023, the good news is there are market fundamentals stabilizing in the multifamily space. for example, interest rates. We went from 0% Fed fund rates to 5.25, and the Fed has hinted at maybe another quarter point increase between now and the end of the year. But after that, they expect things to pretty much like flatten with maybe some slight declines in 2024. Now, nobody has a crystal ball, but directionally, that is a good thing because that means your debt, although it's going to be higher, won't have as much risk applied towards it. So a lot of groups buy properties on variable rate structures and then they get an interest rate cap. Well, because interest rates were spiking so much, interest rate caps were going from $3,000 a month to $63,000 a month, and the interest rate cap escrow time period extended from 12 months out to 18 months. That just creates an extra burden. I mean, just right there, what I gave you from 3 to 63,000 is a situation our group has personally gone through, where you're expected to shell out basically an extra $1 million in an interest rate cap. It's absurd and it's not sustainable for investors. But that's the good news, because things like this are starting to stabilize. It is giving us a better chance to have real actuals moving forward. And the guy that reported on this, his name's Carl Whitaker. He's the director of research at RealPage. And the best way that he summarized it up, and since I'm a football fan, I'll share it with you here, is it's kind of like football. Right now in real estate, we're moving the ball down the field. We're getting first downs, but we're not scoring any touchdowns. And so like we're making progress in the right direction, but we still need to score. And it's going to take patience. It's going to take good fundamentals and work in your own process of owning your real estate asset. And then, just wait it out and stay patient. So that's the other good news. Now, let's follow good news with some bad news or things to watch out for. And I love this article by Joseph Ori in which he laid out 15 commercial real estate investing mistakes. Now, I'm not going to get into every one of them in more detail. Again, the links are in the blog post that I just released a little bit ago. But let me tap into them just really high level. So a few of them, and I'm definitely guilty of it, as I'm sure almost every real estate investor that's invested in anything in the last 3 years, acquiring properties at too low of cap rates. The statistical averages don't go below 5% cap rate. Well, hell, that was nearly impossible over the last 3 to 4 years. Now cap rates have expanded and it's now sitting at, I think, about 4.92%. But yeah, if you buy properties above a 5% cap rate, then you're giving yourself a more favorable position to actually achieve success in the future. Not diversifying your portfolio is another mistake. Really by that is like if you're heavy on office or heavy on hospitality or heavy on multifamily or just focused in Texas and not looking into other things, you're producing risk for yourself that could be minimized through a little bit more diversity in that portfolio. Not performing at property level full due diligence before you make that acquisition. A lot of people just like to trust the people syndicating it, which, hey, we love your trust, but do your own due diligence. Understand the market. Make sure you're asking the right questions. We actually have a book that lays out what types of questions investors should be asking the real estate syndicator so that you're at least getting a more thorough due diligence before you're making a financial commitment. Acquiring properties with negative leverage, never do that. A lot of people are just like, oh, this thing has so much upside. Unless it's a full-on redevelopment, never buy a property that has been in operation and they just claim it's poor management is the reason why they haven't been able to turn a positive cash flow. Only in a redevelopment situation or, buy and build does this make sense to buy a property with huge upside. Don't do that with a property that already has tenants in it. This one I kind of touched on a little bit ago, but it's buying short-term floating rate debt without the protection of a swap or a collar or a cap, whatever you want to call it. A lot of investors were crushed by this. Our group, it included, was hurt by this. Luckily, we did buy an interest rate cap for 2 with the option to extend for 3 years. But those interest rate caps are basically insurance coverage, and they're going to increase their insurance coverage when they feel like they're exposed to more risk. But by not having that cap in place, we would be hurting a lot more. So you do minimize your risk. Now you have to assess how much risk do you really want to take out of it? Do you want to take a full point increase, 2-point increase, etc. Underwriting an acquisition using a terminal cap rate that is less than the going in cap rate. Again, I touched on cap rates earlier. The biggest thing when I was still just a passive investor that I would look out for is the real estate syndicators that are saying, hey, I'm buying it at a 4% cap rate, but it's actually going to go down to a 3% cap rate over the next, 4 years because of the economy. No, no. I always, and our group has always done, hey, if we're buying at a 4% cap rate, we at least factor in at least one full percentage point increase, and generally 2 percentage point increases in cap rate expansion, even if the economy is great, because then you have situations like now where the economy has expanded about 2 percentage cap rates between when we were purchasing properties and where we are now. So we like to protect for the downside and be very conservative. Don't invest in a property where they have a lower cap rate than what you're acquiring it for. And that little tweak, even a quarter point tweak, really changes the number. So just don't do it. You've got things like overly optimistic rent projections and underwriting. That's just like the cap rates, terminal cap rate, not analyzing sales volumes per square foot, just other little details. Not incorporating like the risk when you're assessing it. That's part of your due diligence questions. Hell, if you're thinking about it from a portfolio mindset, people like to go after the gem or the A class asset. And if they're doing a portfolio, they want the A's and the B's, but sometimes those other things, the dogs, the C class assets get thrown in there. And if they're throwing it in there at the same cap rate, no, you should be asking as a buyer for a discount on any C assets that are being thrown in to those A and B class things that have a greater certainty. And then here's something it's so little, but it's extremely valid. Watch out for Excel sheets. I guarantee you there's always going to be one formula that is screwed up. It's just, we're human. Mistakes are made, but hopefully the mistakes made in those Excel sheets aren't material. However, there's going to be some situations, and I found it personally when I was a passive investor, where I noticed, for instance, there was an issue on the calculation of the interest rates. And that had a very big difference. And I highlighted it to that investment team. I didn't actually invest in it because I was like, shit, well, if you're going to make that mistake, what else are you going to make a mistake on? But those are some of the mistakes to watch out for. And then the final article, as we shift here, that I found rather interesting. And again, I'm not a CPA on it, but it's tax advice for passive investors. A lot of passive investors over the past year, when I've gotten in touch with them, they've been frustrated by, what is a passive loss and what is a passive gain, and how are they not able to offset their losses? Because of course, in real estate, you do bonus depreciation, and say you're investing $100,000, historically speaking, you can have 70 to 80% of that, or $70,000 to $80,000, show up as a loss in that first year of investment through depreciation. Well, they thought, oh man, I can offset my active income. That's not correct unless you're an active investor or an active real estate professional, which means 750 plus hours, over 51% of your work, et cetera. So be very wary of the tax benefits as a passive investor, and make sure it's only offsetting your passive losses. Again, find the right CPA that is familiar with real estate. Not all CPAs are alike. So make sure you find somebody that really understands your personal needs. Now, we're going to shift. So we covered, scams to avoid, mistakes to avoid, the good news in real estate, and the tax benefits as a passive investor. I want to shift now our attention to things that I found rather interesting on social media. This guy, you're going to hear a ton. I talked about him last week. I'm going to talk about him again. Grant Cardone. And I'm going to read his post because I love how he phrases it, or whoever his copywriter is. And it goes like this: is your success story is yours to write. It's not a matter of chance. It's a matter of choice. People tend to say they're interested in something, but the path to success means really, truly committing or not at all. It means adding two critically valuable things: commitment and investing. And that investing is in yourself. In other words, time and money is your commitment. Whenever I commit myself to a course of action, I get immediate results. When my commitment is lacking, results are delayed or non-existent. Commitment means devoting yourself completely to something. It means leaving no room for maybes. If you set extraordinary goals, you must have extraordinary commitment. You must go all in on success. Only then will you achieve it. I don't think I need to add any additional thing. My only additional thing is that success leaves clues. So if you want to be successful, find the people that inspire you in the field that you are interested in, and then copy their playbooks. Because if you just copy their playbooks, that's going to get you 70, 80% of the way there. Then the rest is 20 to 30%. That's going to be your work ethic and your commitment to actually making your dreams come true. So I really like what Grant Cardone says. You can love him or hate him, but he does tend to have at least some wise-like thoughts. Another guy that made a post, and I won't read his in more detail, but his name's Pace Morby, and strongly recommend you follow him. He's got some really creative deal financing that he does. And with Pace, he was talking about all about you don't bet on the horse, you bet on the jockey. And that ties to the idea of when you're just getting started in real estate or business or anything like that, people are less likely to make an investment behind you or bet on you without some form of a proven track record, or you're going to need to work with somebody more experienced. And that's just a fact. Like, why would you trust somebody if this is only your first real estate deal versus like our group has done 20 deals now, and we have a 23% internal rate of return, a 26% average annualized return across the projects that we've exited. Like, we have a track record of success, which is why more people are likely to invest with us. That's all about the jockey, not the horse. So just keep that in mind when you're getting started. Maybe partner with the right groups that can help build your book of business and your resume before you break off and do things on your own. Now, another guy in real estate that I really like, and truth be told, I'm part of his mastermind, so I've been able to pull a lot of great information from him. So Jerome Maldonado, great guy. And he talks on this thing that I think is evident for any person trying to create additional streams of income or retire early or create generational wealth, you name it. And he talks about assets and how assets are the only thing that can set you free in your life. You need to be creating cash flow with things you own, or you'll be shackled to your office job and be stuck in that 9 to 5. And he's 100% right. It doesn't mean you shouldn't enjoy your work. Like, enjoying your work is fantastic, and I wouldn't advise leaving your job, but it does mean you should be creating additional streams of income. And a great book I could recommend is Robert Allen's Multiple Streams of Income, and it has multiple editions of it, but it just talks about how you can create exponential wealth by having multiple streams of income versus linear wealth, which is just focusing on that one job's income for you, which is always susceptible to conditions outside of your control. And then finally, a bonus post that I really enjoyed was a recent study by, I believe it's Randall Bell. And what they found was, and it's something so simple, but it can show an indicator of success. People that make their bed in the morning are 206% more likely to become millionaires. That same research study also found that millionaires tend to read for at least 30 minutes a day, and that they wake up 3 hours before their work day starts. So again, without analyzing anything else, look at those 3 things. How often do you read? How often do you make your bed? And how early do you wake up before your workday starts? And that can be an indicator as to whether you will have a successful and financially free future. So now we've covered our top 5, our 3 posts that we found engaging, plus a bonus post on making your bed so that you become a millionaire. Now I want to touch on the blog that we write every single Sunday. It's more of an opinion piece. It's touching on things in my life, and then how I can relay that back to real estate and money. And this one, to take you back, and give me one second. Take you back. I used to play sports all the time when I was growing up, and it was a great way for me to stay out of trouble. I was a very energetic kid, and I can tell you my 1-year-old, he's gotten that energy from me because he won't stop moving. So mom and dad, I understand now. But I used to play on like 2 basketball teams, 2 soccer teams at all point in times in the year, like you name it. I was playing school, AAU, club, etc. And it was just, it was a really good time for me. But one coach that stuck out to me was my 8th grade AAU coach. And he would say it in the huddle. And it has stuck with me still to this day. And his name's Coach Doran. And the line he would give to us is, "This game is chess, not checkers." And at that time, I was just like, I mean, yeah, it's basketball that we're actually playing, and so I didn't think about it too much. But today, that's still ingrained in my mind. And why is that? Because in order to win in life, you need to understand if you are a checker player or a chess player. And of course, I don't mean this literally, but metaphorically. So both games are great, and I personally enjoy playing both of them. And you're not a lesser person if you play one or the other. It just might actually show your preferences in what you want in life. Um, so for a quick disclaimer on like checkers, how you do it if you've never played before, you just move forward and you can never move backward, and the game tends to go pretty fast. And the person that wins is the person that eliminates all the checkers. In chess, you can move forward, backward, diagonal, you name it. There's 16 pieces, with 8 pieces being pawns, 8 being like special characters that can move in different directions, and it's all about hierarchy. And so each group plays a different role. Unlike checkers, everybody's playing the same role. And the person that wins that game is the person that gets checkmate on the opponent's king. So checkers, clear endpoint. Chess can be done in 5 moves or 500 moves and can go on for days. And Dr. Marion Tinsley, I liked what she was saying, and I'll just share verbatim what she said about chess and checkers. She said, chess is like looking out across an ocean, and checkers is like looking down a well. So where am I going with this? And in investing, you can be a checker player or a chess player. There is no right answer. One might make you more than the other, but that same one might require 20x more time for you to operate effectively. For example, if I'm investing in the stock market, I could hire a financial advisor to manage my portfolio. And in theory, this financial advisor will be playing chess with your money to try and get the upper hand versus the market. Unfortunately, decades of research have shown that roughly like 90% of financial advisors don't outperform the market. But still, that's what you can do there. If that's the case, you can have someone playing chess for you. They just may not be winning. But then where am I going now with like checkers for real or for investing in general? Well, you could put that money in index funds, and index funds have a low management fee and everything like that. So whatever growth is there, and it grows with the major indices. Now, where would it maybe make sense to actually play chess with your money? That would be real estate investing. And why is real estate investing great? So you could do checkers, just like you can do checkers on an index fund for stock market. You could do checkers in the equivalent of buying a REIT. But those just go up and down with the market and hasn't really shown any historical advantage. Now, private real estate investing is where you can play chess with your money in real estate. And there's companies like Fundrise where they allow a lot lower minimum in order to access a deal. Like we require $50,000 minimum in order to access a deal. It just makes it easier, better returns for everybody. But Fundrise has some really good educational stuff, and I strongly recommend it. In fact, it's linked in my blog that I mentioned. And you can play with the graphs to see just like how safe private real estate investment is. It's pretty much got the same ratio as a bond, but of course it's a higher return from a risk to return ratio. So I really like private real estate investing. That's where I focus my attention. And it's something that I'd recommend for you as well. But again, if you wanted to figure out your own preferences, that same blog that I'm talking about, they actually have a quiz in there that allows for you to put in various preferences from everything like, do you like to fly or drive, versus like what type of TV do you like, etc. And it actually can spit out the type of investor that you probably are. So anyhow, that is everything for this week. Hopefully you found it educational, engaging, but just let me know. Let me know what else you'd like to hear on a weekly basis as I try to provide more insights behind what's going on in the markets of real estate and money. Thank you for the time, and take care.